the Indian market and the US market works very, very differently. So in India, you have to understand the concept of black money and white money. If you take a look at the last 1 month performance of Nifty, you will see that the markets have come down, then they have gone back up, they have come down, they have gone back up, they have come down, and now hopefully the markets will go up. That is what everyone is hoping. But as I have said on several of my videos, the markets might continue to stay very volatile. So on this video, we are going to understand how you can invest 5 lakh rupees safely in today's market without having a heart attack. So that is the simple agenda of this video. Very important video because I will speak about safe or safe-ish investment options. Just a very quick disclaimer, whatever investment instruments I'm going to speak about, they do carry a little bit of risk, but this is probably the safest way you can design a portfolio of 5 lakh rupees. So let me get the story started. We will understand 4 specific asset classes. I will talk about the best way you can invest, and I will also help you understand how you can invest directly in stocks in today's market where the volatility might be the lowest going forward. Now, I'm sure that a lot of you might comment below that, Akshat, can I not just wait out this volatility and then I will enter the market when everything looks hunky-dory, because that way I will not feel stressed. So I will just wait for the market correction to get over and good story to start, and then I will jump in and I will pour in all my money. It sounds great in theory, but this wait and watch strategy generally does not work in any kind of market because that is just very hard to predict. And even seasoned professionals, for example, Mr. Rakesh Jhunjhunwala, Mr. Ramdev Agrawal, Mr. Radhakrishnan Dhamani, they continue to stay invested in the market majority of the times. It is very difficult to predict the top or the bottom of the market. Yes, it looks like that currently we are going through a turmoil. A lot of correction is happening. People are predicting that we will reach to 15,000 Nifty, etc., etc. No doubt about that. We very well might. But the issue with this theory is that, for example, right now we are at 16,800 Nifty levels. Now tomorrow the market will correct, and now you're reading the news that okay, I will start investing when market goes to 15,000. Then it will not happen. Then it continues to hover around. So you keep on waiting for the market to get to 15,000. It never does. You never invest. A classic case in point is the 2020 COVID crash. A lot of people kept on waiting for the market to touch 7,500 again, right? Because the same type of story was being played out there. And those people are still waiting for the market to go to 7,500 and then they will start investing. These type of scenarios generally do not work out. So as a sensible investor, you must not pull out your old money. So staying invested is what majority of the good investors do, and we should follow that principle. So this will get us to the second point. You will say that, Akshat, I've been investing in the market for the last 2-3 months, but every stock that I have purchased, I'm seeing it in red. I agree. And that is something that is happening to everyone, because if the entire market falls, even good stocks are going to fall. There will be a little bit of short-term pain. So please do not worry about it. What you simply need to do is, if you're really stressed out about buying some high beta stocks, for example, finance oriented sectors usually have a high beta, high volatility. So in those kind of sectors, the correction happens quite quick and fast. In equities or cryptos as an asset class itself, the correction happens quite fast and furious. So all you simply need to do is, you need to come up with a risk minimization strategy. That is what you need to do. And whatever fresh money you are pouring into the market, if you are very scared that, you know what, I'm just done seeing this entire portfolio in red, I just want to invest my money in a sensible way, in a way where I do not see this red thing happening, right? So what is it that you must be doing? Let's start having that discussion. So the number one option that retail investors have to mitigate this risk is to move towards bond market. Now here also bond market is very big, and there are a lot of points that you need to keep in mind. So let me explain 2 very important points here. First and foremost, you must invest your money in secured bonds, not unsecured bonds. What is the meaning? Secured bond simply means that they are secured or backed by an asset. A classic example will be home loan. So when you go to HDFC Bank or ICICI Bank and ask for a home loan, you get that home loan, 10 lakh rupees, then you have to pay an EMI. So till the time all your EMI is not paid out, your bank technically owns the house for which you have taken a loan. So in case you default on an EMI, the bank can technically sell your house and recover its money. So that's secured by what? It's secured by a house. So those are called as secured bonds, and you must go and purchase these if you're looking to minimize your risk. On the flip side, unsecured bonds are slightly more risky. So if you're looking to minimize risk, number one, please take a look at secured loans. Second key point, you must look at senior debt, not subordinate debt. So what is meant by senior bond? So let me take you to Golden Pie. So I made a separate video on how retail investors can purchase bond. You can watch that entire video here. So this gives a very good categorization of secured, unsecured, senior, subordinate debt. So let me just help you apply this filter. So if you go here and scroll through it, you will see seniority, senior and subordinate. So you just simply pick senior. So senior simply means here that in case of a liquidation, for example, there is something called as UP Power Corporation Limited. Now here the yield is 8.25%, and if you click on it, you will get a bunch of different options. So what happens is that in case this UP Power Corporation Limited defaults, then a liquidation exercise takes place. So liquidation simply means that they will go and sell all the power plants, cars, buses, whatever this company owns. And whatever money comes in, so let's say 1 crore rupee comes in, then the first layer of payments will be made to people who own senior bonds, right? So once this entire senior debt is settled, whatever money is left from this 1 CR will be paid to whom? The non-senior people. So there are different layers or categories of bonds also that you need to keep in mind. So remember two very important points about bond investing to lower your risk. Number one, please purchase secured bonds. Number two, please purchase senior bonds. So you can go on Golden Pie's platform, look at this filter criteria and filter it as per the criteria that I have told you. And you will get a list of options and you can execute investment opportunities based on this. Now, your second option in terms of investment is gold. Now, there are 3 key points that I will leave you with regarding gold investments right now. So first and foremost, gold is a great asset in terms of preserving your wealth. Now, what is meant by preserving your wealth? It simply means that, for example, if you invest 100 rupees in gold right now, that 100 rupee will not become like 95 rupees 4 years from now. So the wealth is not getting destroyed. It is staying intact. So that is called as wealth preservation. And gold has been a good asset in terms of wealth preservation. Typically speaking, gold gives out somewhere between 4 to 11% returns on CAGR basis over the last few decades. So from an absolute gain perspective, gold has not given very high returns, but it has preserved wealth. This is the first key thing that you need to remember. Second key thing that you need to remember about gold is that take a look at this chart. Now here what you would see is there is a typical inverse relationship between stock and bond performance and gold performance. So if stocks and bonds are doing well, gold will do really badly. On the flip side, if gold is doing really well, then stocks and bonds are going to do badly. How? For example, if you take a look at the period 2012 to 2018-19, stocks and bonds were doing fairly well. And unfortunately, the gold prices stagnated. Then 2020 COVID hit. You can see this great surge in stock price for gold. Why? Because the stock market did really poorly. So if your assumption is that over the next few months, the stock market is going to do really badly, then it is okay to lock in a little bit of money in gold. Now comes the third and very relevant option for India, because many a times when I say that, gold is not that great an asset in terms of investment, and I still stand by that fact. A lot of people say that, Akshat, Robert Kiyosaki advises buying physical gold. He's also doing this. He's buying silver in physical silver format, etc. The Indian market and the US market works very differently. So in India, you have to understand the concept of black money and white money. Now, a lot of people who have black money have very limited investment options. They can either put their black money in real estate or gold. And a lot of them end up buying gold. So if you are a white money person like me, so all my money is white because I run digital businesses. If you are getting salary, again, you will be getting salary in white. If the money hits your bank account, it's white money. So if you are going and converting that white money into gold, physical gold, it becomes a problem because a lot of black money in India is locked into physical gold. Now, without complicating this issue further, this is the first key point, and therefore that Robert Kiyosaki argument does not typically works in a country like India. More importantly, with white money, if you're going and purchasing physical gold, it's a very expensive transaction in India because the commissions in India are very high from the jeweler side. Now this can range depending on which jeweler you are going and purchasing the gold from. It can range from 3 to 5% for every transaction you are making. So when you are buying gold, you are paying 3 to 4% commission. And again, when you're selling gold, you might be paying the same amount of commission. So the commissions on physical gold is very high in India. So then comes the option that, okay, Akshat, you suggested this. Then what is the best way of investing white money in gold in India? So I would say that either purchase gold ETFs, exchange traded funds, or gold mutual funds. Now I will not show you which ones. Please figure out which ones would make most sense for you. But the bottom line is gold ETFs and gold mutual funds are easier to liquidate also, and the commissions are not that high compared to buying physical gold. Now comes the third safe option, which is real estate. Now, there are multiple ways in which you can purchase real estate, for example, house, commercial properties, REITs, etc. etc. Typically speaking, the best way of investing in real estate right now is that you either go and purchase a commercial property, because those are still giving valuable returns in terms of cash flow that is happening, and a better ratio of rent compared to the price that you have paid for that commercial property. Now, there are a lot of nuances in terms of purchasing commercial property. There is a separate video that I had done on this topic. You can go and watch it to understand more nuances. But the important key takeaway is that commercial properties generally, typically give better returns compared to buying houses or flats. Additionally, if you are purchasing something of a land, right, then of course land has the probability of giving you very high returns and also losing a lot of money for you. So land becomes an even more volatile asset. So if you're going and investing in real estate, then commercial property is what I would recommend. Now you'll say, Akshat, commercial properties or any type of real estate is super expensive. You spoke about investing only 5 lakhs. So how can I go and buy this? So there is an option called as REITs, REITs. So you can go and purchase those REITs. Are they completely safe? The answer is no, they are not completely safe. But given the scenario right now, when the real estate sector is already very beaten down in India and there is a lot of volatility, it is unlikely that REITs will become wealth destroyers. So from that perspective, it is okay to take a little bit of position in REITs. Again, are they going to give you massive returns? I don't know, but this is the typical investment option that you could consider exploring. Now comes the fourth and final option, which is about investing in safe stocks in defensive industries. Now, before I jump in and give you a couple of suggestions here, let me tell you the story of HUL, because many of you feel trapped in the HUL stock. Okay, so let us take a look at the performance of HUL. So over the last 6 months, the stock has corrected by roughly 8.3%. Now let us take a look at Nifty 50 performance over the last 1 month. So Nifty has roughly corrected by 8%. So it is not as if that your wealth has been destroyed by investing in stocks like HUL. Now, why am I saying that something like HUL is still a very risk-free stock? The reason is fairly simple, and let me show it to you in a slightly more zoomed out manner. So whenever you see this happening, that this compounded profit growth is around 15%, that is a very impressive number for a defensive stock. So the easiest way to invest in a lower risk stock is to purchase a stock where the profit growth is roughly 15% or more and it is in a defensive sector. Now, what do I mean by defensive sector? Defensive sector simply means that these are the type of products that you will continue to consume irrespective of a recession in the economy. A classic example will be 2020, that when 2020 COVID hit, you did not stop using toothpaste, toothbrush, shampoo, soaps, etc. So from that perspective, companies like HUL and majority of the FMCG companies kept on going up even during recession. This is the classic sign of a defensive company, that during recession, because we continue to use these type of products, these companies do not get beaten down much. So therefore, identify a company where the compounded profit growth is more than 15%. It simply means that after every 4 years, the company is likely to double its stock price. And that has happened in HUL's case as well. So let me show that to you as well. So if you go in 2012, right? So the stock was trading around 550 levels. So by 2017, it should have been around 1100 levels. So let's see, by 2017, did we hit that? By 2017, did we hit that 1100 level? So we did, right? Then in 2017, we were at 1091 levels, so roughly 1100 levels. Did the stock price hit 2200 in the next 4 to 5 years? The answer again seems to be yes, that we hit roughly 23, 24 and we are hovering around that mark. So what will happen in the next 4 years? So again, the stock price is likely to double from this point. Why does this happen? It happens for a range of reasons, but the most important factor in terms of risk-free or rather low-risk investing is that identify defensive stocks which are giving more than 15% profit growth rate. If you do that, your money is likely to double. Let me know in the comment box which other stocks you can identify which meet this particular criteria. So in summary, there are 4 great options. One is bond. Definitely go and explore Golden Pie. It's a very good platform. I have personally used it and invested my parents' money through it. Number 2, gold. You can consider taking little bit of positions only. Don't take very large positions. Number 3 is real estate, especially REITs. 4th and finally, you can take positions in defensive, profit-oriented stocks. Now comes the final question, that how much money should I invest in each of these 4 categories? It really boils down to whatever you are more comfortable with. For example, if you feel more comfortable taking positions in bond and if you're okay with that type of return, please take more positions in it. Otherwise, you can do a complete opposite. You can invest 100% of your slightly low risk investment in FMCG stocks purely. So I hope you enjoyed the video and learned something new. Please give it a thumbs up and I will see you tomorrow.